median existing home price for all housing types in October was $379,100, a gain of 6.6% from October 21, which was $355,700. Now, although we saw a rise from October 2021 to October 2022, prices have gone down from record highs in 2022. What does this all mean? Rate hikes are starting to do their job. As we start to see a decrease of home prices in the market, this is signaling that inflation is starting to settle. The recent CPI data showed that although inflation numbers still aren't considered low, we are moving in the right direction, dropping from 8.2% in September to 7.7% in October. Now, this is great and all, but this doesn't help the immediate problem at hand. If you're in your late 50s and 60s, you most likely paid off the majority of your mortgage, if not all of it by now. But if you're like the majority of homeowners in the US, you are most likely still paying off a mortgage on your house. The immediate problem we run into is people still on a variable rate mortgage, which only makes up about 5% of the population who have a variable rate mortgage who also buy it within the last 12 months. For example, if you bought a home years ago for $200,000 in the USA and your rate has doubled, that sucks, but boo-hoo. Your mortgage is still pretty low. However, if you bought a home at $600,000 at the peak and rates have now doubled and you make a modest total family income of about $80,000 a year for most Americans, now that hurts. See, rates have almost doubled since January of this year. This means people on a variable rate have had a massive increase in their mortgage payments. In times like today, where the cost of living is already expensive, who has the extra money to be paying towards their mortgage payments? The next problem we have are people who are coming to the end of their fixed rate mortgage cycle. Many people who have locked in pre-recession low mortgage rates for 5 years will now be up for renewal within the next 12 to 24 months. Now, if you're in the US, most of you get a 30-year mortgage, so not to worry unless something changes in your personal life where you have to sell. But here in Canada, our mortgages are only fixed for 5 years. Why? I don't know. Oh, it's because our Canadian government isn't as nice as the world perceives us, and they're pretty greedy.
People kind?
No surprise. A few years ago, no one would think twice about their mortgage being renewed, as they would just have remortgage onto a new rate similar to what they've had for the past 10 years. Now, the problem is that homeowners can't just do that right now, since they are going to be remortgaging into rates that are 6 to 7%, if not more, by the time this video comes out. The reality is that this time last year, a lot of us stretched our mortgages because interest rates were so low, which means we could afford a lot more debt from the bank. The problem is that that same debt we took on for such a low percentage now needs to be paid off at a much higher percentage rate. This also means that everybody's affordability has been massively reduced. So what does this all mean? As we see people's affordability get reduced, this will create less demand in the market, essentially bringing down prices of real estate. Homeowners have gotten to enjoy a great boom for the last few years, but we've now reached a tipping point in the market. As prices continue to go down, homeowners will hold onto their homes as they are less likely to sell at a lower price. On top of that, buyers will be waiting on the sidelines with their cash, waiting for the bottom until they can afford to purchase a property again. So there's this back and forth battle going on. Should you buy now or wait? This will really depend on your current financial situation. As prices go down, this opens up more opportunities for investors and first-time homebuyers. The problem is that mortgage rates will be incredibly high for the next little bit. But if you can afford to pay the monthly payments for the next 1 to 2 years, you can always refinance your home in the future for a better rate when rates eventually come down. And they will come down. The Fed can't keep rates this high for too long, as they owe interest on their debts. Oh, and they have a lot of debt, so they can't afford this either. This has just been a temporary measure. So if you are going to be buying real estate, whether as an investor or just a homeowner, this is an amazing time. There hasn't been a better time to buy real estate, in my opinion, since 2008, as long as you have a 5-year plan and you're buying in quality cities that have quality job growth, quality population growth, quality rental demand, all the stuff that makes a city desirable to live in. Buy in those cities. So as long as you're buying in a city that actually has action and jobs going on, you will be fine. The market will be more resilient in those areas as long as you hold for 5 years minimum. My strategy is for myself, my investors, my clients, my partners, everybody, is let's take advantage of the market. Let's buy now, lock in that low price, wait 1 to 2 years, get punched in the face with the higher interest rate payments. I get that, but in 1 to 2 years, we can refinance when the rates are lower and then hold for another 3 to 4 or 5 more years and then sell at that point. This is the new chess game. This is how real estate must be played now. We can't invest with the same same techniques we were doing 12 months ago, 2 years ago. The people who are taking advantage of this and know what's going to happen in the market, because it always happens the same way. Over and over and over again, long-term real estate is the way to go. Interest rates will come down after inflation comes down, which it already is starting to tipping point and come down. So we know the roadmap. We just have to be patient and hold and play the game. But if you're willing to play the game, you will make a lot of money.